Yesterday, the European currency extended losses against the dollar, weighed down by upbeat data from the United States. The better-than-expected ISM's manufacturing PMI supported the greenback ahead of today's Fed meeting. Thus, both the euro and the British pound continue to trade under pressure. This will become increasingly apparent after the US Federal Reserve announces its interest rate increase. Today, the focus of market participants will be on the Fed's decision on interest rates. The regulator is expected to raise its key rate by 75 basis points to 4%. Moreover, economists assume that the US Central Bank will stick to its existing policy and probably lift the rate by 50 basis points in December this year and 25 basis points in 2023. At the same time, many expect Fed Chair Jerome Powell to soften his tone and announce the need to temper the pace of aggressive rate hikes hurting the economy. Nevertheless, I believe that it is still premature to talk about a shift in monetary policy. After all, Fed officials have repeatedly stressed that sharp rate cuts following aggressive increases will not allow them to get the economy back on an even keel. Thus, the US Central Bank will most likely keep fighting inflation aggressively enough as there are no clear signs of its cooling. Again, this will contribute to the strength of the dollar, thus dragging risk assets down to new lows. Moreover, given that the US is edging toward a recession, demand for the greenback is likely to remain strong. Therefore, it is too difficult to predict the outcome of the Fed meeting. Of course, if the Fed hints at possible monetary easing, the euro and the pound sterling may gain strong pressure momentum. In this case, the market will begin to reverse. As for other fundamental factors, traders may take notice of important reports from Germany, such as data on unemployment and manufacturing activity. The euro area is also set to release its manufacturing PMI. The indicator is expected to remain below 50, which will probably exert additional pressure on the euro. Besides, it's worth paying attention to the ADP National Employment Report. The US economy is forecast to add 195,000 non-farm payrolls in October, after 208,000 increase in September. On the other hand, a further decline in this reading will be good for the Fed. On the other hand, this will be a bad omen for the US economy. So the dollar is unlikely to react positively to downbeat data on the labor market. And now let's consider the euro-dollar pair from a technical point of view. According to the 1-hour chart, I recommend focusing on the levels of 0.9906 and 0.9857. If the price returns to 0.9906 and tests it from the top down following upbeat data from Germany, the euro is expected to advance to 0.9950 and probably 0.9995. A rise above this level will be possible only after the Fed announces its latest policy decision. A false breakout at 0.9906 or 0.9950 will create a sell signal. In this case, bears will most likely bring the euro down to 0.9857. If the price breaks through this mark and tests it from the bottom up, provided that the US Central Bank decides to stick to its aggressive rate hike path, the euro will slide to 0.9816, 0.9784 and 0.9747. At the levels of 0.9784 and 0.9747, it will be possible to go long on a rebound. Long positions at 0.9816 and 0.9857 can be considered only amid a false breakout. Speaking of the British pound, the situation is somewhat similar. The pound-dollar pair is still in a correction. The price hit fresh lows, but then returned to 1.1496. A false breakout at this level will create a buy signal. If the price comes back to 1.1556 and tests it from the top down, the British pound will gain to 1.1610 and probably 1.1666. In this case, this correction will come to an end and the pair will resume its bullish run. If the price forms a false breakout at 1.1556 or 1.1610, the volume of short positions will increase. Likewise, a sell signal will be generated in case the price falls below 1.1496 in late afternoon trade and tests it from the bottom up. Furthermore, if the Fed signals further aggressive interest rate measures, the pound sterling will break below 1.1439. Then the British currency will most likely head towards 1.1392 and 1.1348, thus breaking its bullish trend initiated on October 21. Traders may go long on a rebound at the levels of 1.1346 and 1.1307. Long positions amid a false breakout will be relevant at 1.1392 and 1.1439. Good luck!